Imagine waking up tomorrow to find that the world's biggest tech companies completely halted their spending on artificial intelligence. The global stock market would likely panic. Right now, one of the primary assumptions holding up the global economy is that AI will become so valuable that almost any amount of upfront spending is justified. This chart shows the projected capital expenditure for Amazon, Alphabet, Microsoft, and Meta in 2026. By some estimates, these giants are on track to spend a combined $700 billion in a single year, an enormous jump compared to standard historical tech spending. That money is buying physical AI infrastructure. We are talking about specialized microchips, industrial cooling systems, heavily stacked server racks, and massive new data centers. The strange part of this financial commitment is that nobody actually knows exactly when all the spending will finally pay for itself. The world's biggest technology companies are pouring cash in at an unrelenting pace, hoping the end consumer revenue eventually catches up to the infrastructure costs. Because the end consumer revenue has not materialized to cover those costs yet, it leaves us to determine if we are witnessing a permanent shift in how the world operates, or simply the largest investment bubble since the dot-com era. Calling AI a bubble does not mean the technology is fake. Artificial intelligence is already producing real products, real revenue, and measurable productivity gains. Companies are genuinely buying enormous amounts of computing power. In fiscal 2026, NVIDIA generated nearly $216 billion in revenue, with its data center business alone bringing in over $62 billion in just the fourth quarter. Those are real dollars exchanging hands. This split-screen comparison shows the core economic difference between traditional tech and AI. On the left, a standard software company builds an application once and sells it to millions of users with incredibly low marginal costs. On the right, running large AI models requires an enormous, continuously growing stack of physical resources. You need specialized hardware, dedicated servers, and massive amounts of electricity, and you need all of it continuously every single time a user queries the model. Because operational costs scale right alongside usage, the tech industry is forced into a state of continuous, accelerating physical spending to maintain its baseline operations. This flowchart maps how the AI economy currently funds itself without relying heavily on everyday consumers. It operates as a closed loop, starting here with Company A, which spends billions to build raw computing infrastructure. Company A invests massive amounts of capital up front to construct the data centers and fill them with the latest specialized GPUs. Then, Company B purchases access to that exact infrastructure so they can train and develop their own AI products. Venture capitalists and institutional investors see the demand for AI and pour vast amounts of funding directly into Company B to capture a share of the market. Flush with investor cash, Company B turns around and routes that money right back to Company A to buy even more computing infrastructure. The capital keeps moving around the same internal ecosystem, driving up revenue for the providers and encouraging even more outside investment. This visualization of major tech balance sheets reveals roughly $1.09 trillion in future data center lease obligations. Because of accounting rules, much of this sits off the main balance sheet as shadow debt, used to keep the ecosystem spinning. Free cash flow is the money a company actually has left after paying for its operations and investments. At the current trajectory, major hyperscalers could collectively spend more on capital expenditures than they generate in free cash flow by 2027. If you are spending more cash than you are generating, you have to finance the difference. This closed loop inflates market valuations, building an ecosystem that survives heavily on borrowed belief in tomorrow rather than economic reality today. Eventually, someone outside of this tech ecosystem has to pay for all of this. The industry has to generate enough external economic value from actual paying customers to support that staggering infrastructure cost. Having millions of people casually use an AI assistant is impressive, but those users do not currently generate enough revenue to cover the enormous computing costs required to process every single request they type. If that economic gap doesn't close fast enough, the market will adjust. An AI bubble wouldn't necessarily end with a sudden explosion. It could happen slowly. Demand grows slower than expected. Companies find themselves with too much computing capacity. Cloud prices fall, and massive data center projects simply get delayed or abandoned. We saw exactly this dynamic during the dot-com boom. The internet was real, and it eventually became the backbone of modern trade. But back then, investors paid prices based on expectations that were impossible to sustain. The internet didn't fail, the valuations did. AI might eventually integrate into almost every business process, while the specific companies and investors behind it today still lose everything. The technology can be right, while the investment thesis is wrong. AI can be revolutionary and still be overpriced. Today, we are paying a massive premium for the future, without knowing who will ultimately be left holding the bill.